Welcome to this session, and today we're going to look at what we call advanced financial management, of course. So it is advanced financial management. And today I would want us to look at what we call valuation of mergers and acquisitions. So we have here valuation of mergers and acquisitions. Valuations of mergers and acquisitions. Ladies and gentlemen, there is no way you will go buying a company without knowing its true value, without knowing its intrinsic value. Intrinsic like this. There's no way. Intrinsic value. Intrinsic was the true value of a firm. So for you to be able to get this true value of a firm, then you will need to do what we call firm valuation. One of the ways that you would use to do firm valuation, ladies and gentlemen, is to look at its cash flows generated. How much cash flows is it creating? So if it's RCM, for example, we are creating cash flows, of course, from our students who are paying fees. That's our business model. All right. So then a prospective buyer of RCM, we look at these fees payments versus expenses, get profits, change profits to cash flows over a number of years. They could be like 10 years. All right. They could be like 10 years. So take those future cash flows and then they do what they discount. When they discount like that, then they are able to give us what we call a discounted cash flow, which will be exactly the value of that organization. Yeah, so you can get value of an organization by discounting its cash flows. You can get value of an organization by discounting its cash flows. Ladies and gentlemen, we have various methods. And one of the methods that we shall be using here most of the times is what we call the discounted cash flow method. The discounted cash flow method, the DCF method here, DCF method. Now, I'm so sure you guys are now very good at discounting. All right, just as a quick way of remembering, remember we have got two types of cash flows. We have two types of cash flows. We have two types of cash flows. We have two types of cash flows. So number one, we have irregular cash flows. And then number two, of course, we have what we call the regular, which are also known as annuities or uniform. Irregular, which are also known as uniform or annuities like that. Now, could you kindly remind Mwalimu here, which criteria do we normally use in this case here to discount irregular cash flows? Is there somebody who is able to remind us a criteria that we shall be using to discount irregular? To discount irregular, we normally use which criteria? To discount irregular, my good students, to discount irregular, we normally use PVIF. You're right. We normally use present value interest factor. To discount, in this case, irregular, we normally use present value interest present value interest factor. By the way, these notes can as well be used here for what here for financial management. Very good for financial management. All right. So we normally use what we call PVIF, present value interest factor. And whenever these cash flows are repetitive, whenever they're uniform, like today, for example, we have 10, next year 10, another year 10, so repetitive cash flows. So repetitive cash flows, to discount them, we shall be using what we call PVIF. We shall be using what we call present value interest factor of an annuity. Mine this morning is to come and just remind you the basic formulas. How do we get our present value interest factor? To get our present value interest factor, we normally take 1 plus r raised to negative n. This is present value interest factor. 1 plus r raised to negative n. And ladies and gentlemen, after getting PVIF, I must be at a position as a finance scholar of knowing how to get PVIF. of knowing how to get PVFA, present value interest factor of an annuity. This is very easy. So it will be 1 minus 1 plus R raised to negative N. So you take 1 minus this simple formula. You take 1 minus this simple formula, and then we'll come and divide everything by R. You divide everything by R like that. You divide everything by R. You divide everything by R like that. And then, of course, it cannot go without us mentioning something very, very important. What about in a situation where, fine, we want to get PVFA, but now this time around, when N is infinity, when N is infinity. So when N is infinity, my good students, infinity, of course, perpetuity, without an end inside. This one here will be 1 minus 1 plus R raised to negative infinity, or over what here. Now our N is infinity. Now we're talking of N. Now our N is infinity. Our N is infinity. Now, my good students, let's look at it this way. When, for example, you have here 1 plus, say, 0.1. Let's work with 1 plus this part alone. All right. So 1 plus 0.1, and then you raise this to negative 10. Is there somebody who can give me this answer? When N is 10, when N is 10, when N is 10, when N is 10, everybody must be able to raise this. You say 1.1 raised to negative 10. 1.1 raised to negative 10. Can somebody give me this answer? Must be very small. So we have here 0.3855. Thank you so very much. Then from there we have 1 plus the same R, right? But N now has increased to 100. N now has increased to 100. N has now increased to 100. So is there somebody who can give me this 1 plus 0.1, which is 1.1, right? So 1.1 raised to negative 100. 1.1 raised to negative 100. What figure are we going to get there? What figure are we going to get here? 1 plus 0.1 raised to negative 100. What figure are we going to get here? So in this case here, this will be 7.257 times 10 raised to negative what here? Times 10 raised to negative what here? I know the standard form, everybody is able to see that standard form. Times 10 raised to negative 5. And then you remember very well, in your high school, you are told, whenever it is written minus 5 like that, in your high school, whenever it's written minus 5 like that, to write in the normal form, because at the standard form, we are writing 5 zeros. So you write 5 zeros like that. So we have 5 zeros, 1, 2, 3, 4, 5. All right. And then thereafter, what do you do? Now you write this number without a decimal. You write the number without a decimal, 7257. And then don't add any other zero. Don't add any other zero. These zeros are 5, 1, 2, 3, 4, 5. So in between the first 2 zeros here, in between the first 2 zeros, put a decimal. Put a decimal. It depends on the high school that you went, ladies and gentlemen. There are people, I'm so sure, amongst ourselves who are counting these things like this from here 1, 2, 3, 4, 5. I mean, it doesn't matter. But I mean, the professional way of writing this, if, for example, you're given here 2.3 times 10 raised to negative 3, you simply write 3 zeros before 23 now. And then you put a decimal like that. You put a decimal. Is there anybody, be very honest with me, is there anybody who went to school during those days when they were counting like this, or any school where they are counting like that? Be very honest with me. All right, great, yeah, that is us. That is us, great. So today you've learned something new. So today you've learned something new. 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 Great, thank you, Bev. We shall overcome. Now, my good students, please listen. So then what happens? What do you think in this case it will happen? Like if you say 1 plus 0.1 raised to minus, I mean, this will be like impossible. 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 Now, if you remember very well, we're looking at PV4. We're looking at PV4 when N is in infinity. So when N is in infinity, you're saying it's 1 minus 1 plus R raised to negative n divided by r. So when this n is infinity, it means that as this n becomes big and big, when this n becomes big and big, this number here becomes smaller and smaller, and it is tending towards 0. This number here becomes smaller and smaller, and it is tending towards what? Towards 0. So whenever n is infinity, then we are better off not writing this number, not writing that particular function there. So PV far, when n is infinity, will always be equal to 1 over what here? 1 over r. 1 over r. So this is a very, very important formula for us. PV far, whenever n is infinity, will be 1 over what here? 1 over r. Are we together, ladies and gentlemen, up to here, 1 over r concept? When n is infinity, are we together? But when n is infinity, then PV far will be 1 over r. All right. Thank you so much. Now, from there, ladies and gentlemen, I would want us now to get serious. Let's get serious with our lives. Get very serious with our lives. So then, what if in this case here somebody tells you that in this case here we have XYZ as an illustration, expects to receive Kenya shillings 10 million per annum indefinitely. All right, and then they're giving us Coke as 5%. Coke has 5%. So we're required to determine the present value. Determine the total present value. So an exercise. So we expect to receive 10 million every year indefinitely without an end in sight, where n is infinity. So remember, we can either talk of indefinitely, we can talk of perpetuity, all right, perpetuity, very, very important, or infinity. Or infinity. This is very, very important. So in this case here, for me to be able to get the total present value solution, the total present value, I will take the annuity amount. The annuity amount, I multiply this with the PV far when n is infinity. You want to get total present value when n is infinity. When n is infinity, I will take the annuity amount times PV far when n is infinity. Annuity amount times PV far when n is infinity. Great. So this one here will be equal to A times this PV far when n is infinity. This will be 1 over r. PV far when n is infinity, it's this 1 over r. Which basically will translate to what here? Which will translate to amount divided by r. Very important. Whenever I want to get total present value, when n is infinity, you will take the amount in question, you simply prop it up. You simply divide by r. The amount in question, you divide by r. So the amount in this case here, the amount is 10 million. The amount is 10 million, and then you shall be able to come and divide this by r. And our r, the cost of capital, is 0.05. The cost of capital is 0.05. So is there somebody in this case here? Who can give us this total present value? It's quite a huge figure. 200 million. Thank you so much. I hope everybody is able to follow up to here, because nobody will be deriving. Nobody will ever ask you to derive these formulas. Mine is to remember vividly that present value, whenever I have an infinite amount, it will be the amount divided by r. So the moment I remember, I hope everybody is able to follow up to here, because nobody will be deriving. Nobody will ever ask you to derive these formulas. Mine is to remember vividly that present value, whenever I have an infinite amount, it will be the amount divided by R. So the moment I remember just that, then I'm done. That is enough for me. That's good for me. Then I'm done. Then I'm done. Then I'm done. Now, my good students, very best students here, please listen and listen to me very well. In this case, I would want us to look at example 2. Example 2, example exercise. Yeah. So exercise in this case here, we have our great gentleman here called Gashagua expects. You know, he's a serious investor, shareholder, expects to receive Kenya shillings 10 million per annum indefinitely. Full stop. His cash flow is expected. His cash flow is expected to grow by 2% per annum. By 2% per annum. By 2% per annum. Yeah. By 2% per annum. The cost of capital is 5%. So we are required to determine the total present value. We are required to determine the total present value. Very easy solution. So very fast, I will remember here very fast that total present value will be equal to, I will remember it is amount over R. I will remember very well what is amount over R. And this amount, of course, now is not going to be like constant. There is some growth rate. So whenever there is growth rate, we know we shall come and talk of 1 plus G, and then we shall do an adjustment for this rate of return. For this rate of return, we shall do an adjustment. We shall come and deduct what here? We shall come and deduct G. Yeah, so the amount up there will grow with that 1 plus G, and then down in the return, there's an adjustment that so many people forget. So I'll be able to come and take away the G, the growth rate, from the R. So, ladies and gentlemen, this is what is going to happen. So what will be happening here is that I will have here my total present value. The amount is 10 million. Into 1 plus the growth rate. The growth rate we expect to grow by 2%, 0.02. All over R is the cost of capital. R is the required return. You know, the investors need that as a return, but a company is incurring that as a cost. So those terms will be used interchangeably. So we have R, which is the cost of capital, minus 0.02. Like that. So can you kindly go ahead and give me I know the denominator will be 0.03. But how about the numerator? Can someone tell me, in this case here, 10 million times 1.02. 10 million times 1.02 will give me what figure? 10 million times 1.02 will end up giving me what figure? 10 million times 1.02, I mean, will end up giving me 10,200,000. So then is there somebody who is able to give me this quite an ugly figure? I know the figure will be very ugly. So we have here 10,200 divided by 0. So this gives me, somebody tells me it's not ugly actually, it is 340 million. So this is 340 million. So up to here, ladies and gentlemen, are we somehow together? Up to here, ladies and gentlemen, are we somehow together? Up to here, are we somehow together? Yes, thank you so much. Ladies and gentlemen, what I would want us to do, pretty fast, is to remember out of this, there is a very important formula I would want us to remember. What I will be calling in class here the Gachagwa's model. The Gachagwa's model, but of course you shall never, the Gachagwa's model, but of course you shall never do what here, you shall never quote it in an exam as Gachagwa's, please just ours. Because remember, Gachagua is the one who keeps on talking about shareholding, right? The government of shareholders, right? Where people are getting dividends, right? Where in this case, you remember this guy was a DO, you remember very well. So the Gashagua's model, he was in provincial administration, if you remember, provincial officer will be equal to DO into 1 plus, the DO has to grow. The DO has to grow. The DO has to grow. Yeah, for him to get into provincial officer status, the DO has to grow. And ladies and gentlemen, if you guys think that Gachagua is a pushover, no. I don't like him so much. Of course, he's not really representing like the whole Kenya from his statements, unfortunately, but he's not a pushover. That guy is a clever man. So if you try in this case here to just remove him like anyhow, like today I'm told something may come to parliament, then we'll always remember it will be Kenya without what here? A government. It will be Kenya without a government, because I don't think he can go home alone. He can't go home alone. That guy give him a mic. Yeah, he's very good with words. He's a linguistic person. Yeah, Kenya without government. Kenya without government. So this is really, really a very, very important formula that all of us in this case should be able to remember. In all our financial management, this formula is it must appear somewhere. In your exam, it must appear somewhere. Yeah, I wish our Dr. Great William Ruto here would be well advised. Gachagua may ban everything. Gachagua may ban everything. Is there somebody who is there? As much as we not like him, he must have invested heavily into whatever the government of the day, right? During those days. Do you think in this case, ladies and gentlemen, that man can just be pushed over that easily? Let's be very honest. Let's look at this thing objectively. You may not like him, but do you think he will be able to be pushed over just easily, and then people forget? Or is it good to talk about politics in the morning? For every action, there will be an equal opposite what here? Reaction. We shall overcome. We shall overcome. So it's called the Gachagwa's model. Gachagwa's model. Kenya without government. So now come back to business. This PO stands for what here? Current, because of the O. Current market price per share. Current market price per share. Then we have this G, which stands for growth rate. Which stands for growth rate. Which stands for growth rate. Then we have in this case, ladies and gentlemen, KE is cost of equity. Cost of equity. Cost of equity. You see, this model comes from this. If you're a kid, you must have realized. This model comes from this. Of course, you have DO. DO stands for current dividends per share. Current dividends per share. Current dividends per share. Current dividends per share. Yeah, so this is Gachagwa's model. We can talk about valuation of dividends, valuation of shares, valuation of companies without mentioning Gachagwa's model. Very, very important model. Very, very important model. All right, 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 all right. Now, ladies and gentlemen, please come back here. I would want us to really, really understand this. You see, at this level, there is nobody who will be able to give you growth rate. You must know how to compute growth rate. How do you compute G? So computations of G here. Computations of G. Two methods. Two methods. So number one, for example, we'll be having like 2020, 2021, 2022, 2023, and then we have 2024. And then these are our dividends per share. These would have been 10, 10.1, 10.2, 9.3, and we have 10.15. All right. So, ladies and gentlemen, you can see in this case here, these dividends have been flowing under this mixed growth rate here, but you can see things are happening here. Generally, there is a growth rate, generally, right? And of course, the growth rate will be between this and this last one. So then in this case here, we are required to calculate G, required, calculate the dividends, calculate the dividends growth rate. 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 So the dividends growth rate, what we shall do, we shall come and talk of 1 plus G. 1 plus G equals N minus 1 root. Then we talk of current DPS over oldest DPS. Current DPS all over oldest DPS. The current DPS all over oldest DPS. Please, DPS stands for dividends per share. You can write that in full somewhere. So 1 plus growth rate. Normally write like this. 1 plus growth rate equals N minus 1. N minus 1 root of current DPS over oldest 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 DPS. So N represents the number of years. So if you count, these are 1, 2, 3, 4, 5 years. So N in this case is 5. N is 5. And therefore N minus 1, 5 minus 1. So this will be 4. So here we should use 4. So we are saying here that our 1 plus G will be equal to the fourth root of the current dividend per share. The most current dividend per share is this 10.15. The most current, this is the most current, is 10.15. 10.15 all over. In this case here, we have the oldest DPS, which is what here? Which is 10. Which is 10. So please remember to put this in brackets. And remember, we're not using the normal square root. No, I will say 4, and then I say shift, so that they get the x root. We are making use of the x root. We are making use of the x root. So 4 x root. Then we have here 10.15, 10.15 divided by 10. Ensure you're putting this in brackets. So is there somebody who is able to give me this? Remember, we're using one called, if you're very keen, you will be able to see x root there. If you are very keen, you'll be able to see x root in your calculator there, on the pad there. You're able to see in this case here, x root. So the Kamau is giving me that this 1 plus growth rate equals 1 point something. 1.0372. 1.0372. So is there somebody who is able to get this item here to be 1.0372? Anybody who is able to get that 1.0372? 1.0372. All right. And for some reasons, there are students who are not able to see that x root. For some reason, about 10% of my students will not be able to see that x root. So if you're not able to see that x root, then there's no problem. There's a solution for you. What you'll do, you'll come and write here 1 plus G equals 10.15 over 10. Put this in bracket, and then you say raised to. So you say raised, there's a raised to. So you see, if I'm raising 2, then this will be a quarter. You see, fourth root is the same as a quarter. If I talk of fifth root, it will be the same as a 1 over 5, fifth root. So then what I'll do with my calculator, I will come and open my bracket here. I will say 10.15 divided by 10, you close. And then there is now a raised. Honestly speaking, you can't fail to see x root, and then you fail to see raised to. So now you say raised to, you must use brackets. Raised to 1 divided by 4, you close. And somebody in this case here confirm that if you do it this way, it will end up giving you 1.0372. Can somebody confirm that? Can somebody confirm that? Will it end up giving us 1.0 correct? Thank you so much. So now in this case, the ball is in your court. When they tell you 10 through here, then you know very well it will be raised to 1 over 10. So then therefore, my G will be 1.0372 minus 1. So my G will be equal to 0.0372, which will be the same as 3.72 at here per percent. 3.72%. So we've been able to get growth rate, which we shall be able to use. When we'll be talking about valuation of AFM, you'll see our PO, DO is 1 plus G all over cost of equity. So this G, nobody will ever give you the G. Nobody will ever give you this G. Nobody will ever give you this G. You must know how to calculate it. So how I wish you wrote here exercise 1. Exercise 1. This is exercise 1. So now you can go to exercise 2. Can I proceed to exercise 2, ladies and gentlemen? Can I go to exercise number 2? Yeah, great. So exercise number 2. Exercise number 2. Exercise number 2. Exercise number 2. Now, I was surprised the other day, most accountants in this case have got really no great lives within them. Of course, I know most of you guys are rich, good jobs here and there, which is really very, very good. But in terms of exposure and just the general knowledge of life, most of us are not really, really very good. So the other time, I went with students, in this case here to TRM. So under TRM there, they have these very good videos, right? Yeah, there is a place where they show people movies, all right? All right? Is anybody who has ever been to that place where they show a TRM of this great technology, where they show, in this case here, very good movies? Is the answer really correct? I don't know. What did you get? Let's get back a little bit. Let's get back a little bit. Let's get back a little bit. So in this case here, we have here, it was 1 plus G equals 1 point, was it 03 something, 1 point something, 1.03 something, 1.0, is it 00, 1.00, 1.00372 like that, 1.00372. Therefore, G will be 1.00372 minus 1, which will be 0.00372 like that. So of course, times 100, and that will end up giving us 0.372%. Thank you for that. So now I believe this is the correct answer, right? I believe now this is correct. Yeah. So tunaenda na wanafunzi pale straight away kwa hiyo movie area, movie theater. So hawa kujua kwamba hiyo kitu iko na effects. Yeah. It's not your normal like IMAX thing. It's in this case here quite, it has effects here. So if in the movie, it's raining in the movie, automatically also this auditorium where you're watching this movie from, you expect this theater also to, give you some raindrops. All right. Yeah. If you see a snake, in this case here, passing in the movie, then down there, they've put in this case some great things in this case that will also feel they are touching you. I'm telling you, I'm the only one who was left in that movie theater for the whole 15 minutes. People started screaming, all right? People started screaming. 1-2 minutes in this case, when that young lady was coming up with a knife, they come up with this kind of, and you think that this lady is stabbing you. And the sound is really crazy up there. And in this case here, these students were able to run away, all right? So even in music, have you ever seen any accountant really who knows how to dance? Mwai Kibaki was given an honorary CPA. At least Mwai Kibaki, may his soul rest in peace, tried. He was able at times to pull the wife to dancing floor to open water here, some great dancing session. All right. But I can tell you, accountants, in this case here, we and life, we are really opposite directions. All right. So we have a very, very important exercise, ladies and gentlemen, here that I would want us to do, which is exercise number 2. Exercise number 2. Exercise number 2, where in this case here, exercise number 2, where in this case here, we want to calculate growth rate when returns and retention ratio. Retention ratio and retention ratio and retention ratio is given. Retention ratio is given. So exercise 2, how do we get growth when returns and retention ratio are given, both of them. So to get this, ladies and gentlemen, we normally say growth rate equals R and B, RB. The genre of music called what here? R&B. R. Please write your R very well. My handwriting is not the very best. Write your R very well. So where these are return, the return. It will be return on equity, return on investment. And then this B is the retention ratio. Retention ratio. This B is the retention ratio. Retention ratio. Ladies and gentlemen, remember, if you want to grow generally, in even our personal lives, what matters is what are you able to retain out of your salary. It's not about like how much you're earning. That's why some people come and tell me that they're earning 700,000, 300,000. But at the end of the day, if you're not able to retain something out of your income, you're as good as somebody who's not employed. That is why if you go to any local area today, like where I come from, I can tell you the most progressive people at home where I come from are primary school teachers. Primary school teachers are really you can see in this case here, the very best houses, they belong to primary school teachers. All right. Very best cows at home, they belong to primary school teachers. But how much do they earn? How much do they earn? Very little, maybe below 50,000 shillings. All right. So basically, they are very good in retention. Most of them work from their home areas. They ride bicycles, in this case, at their workplaces. So bus fare is almost zero, negligible, right? So they are able to retain. They are able to do what they are able to retain. They're able to retain. So if you're retaining your money here, if you're retaining your cash here, and the cash that you're retaining, you're putting it into investments, where you're able to get a return, then automatically you'll be able to grow. The same case with a firm. When you will become a finance manager and the organization has earned, for example, you have an earnings per share, for example, of 10. Please don't give away 10. Don't give away 10. You must convince your investors enough so that you can retain like 40%, you can retain like 30%. We must retain. And whenever we are retaining and investing, this money is back to the company's operations, then that is how companies in this grow. Do you know why most of our circles in this case here, some of our circles, not all of our circles here, some of our circles are really, really growing? It's because of what here? It's because of a heavy retentions here. But you know, there are circles in this case here, there are circles which are not, actually there are circles when they earn 10, they are paying 12. So they even go out there borrowing to pay dividends, to finance payment of their dividends. And remember, borrowing to finance dividends is even unlawful, it's illegal. But for directors here to sustain their positions, that's what they're doing. So at the end of the day, you keep on eating the company. Just like, for example, these money market funds. Look at the very biggest money market funds like CIC. Their rate of return is quite minimal, all right? And because of that, putting the return very, very minimal, these guys are able to grow every other day. The company becomes what here, very stable. But look at some of these small firms that have come here, MMF, which was created here like last year. Now they're giving a return of 18%. I mean, where will they be able to invest even the money you're giving them for them to earn 18%? You know, as investors, we also need to ask ourselves whenever we're putting our monies to some of these risk ventures, all right? Because what basically they're doing, they're financing, in this case here, what they're able to give you as a return from investments from other people. That's why they are aggressively marketing. So they get, in this case here, other people coming in, they tell you bring family, etc. Without knowing, within no time, then the bubble will burst. Because they not keep continuing, in this case, even most of these big circles are now doing like that. Most of these big circles here now, they have, gone into an overdrive of looking for what here for customers. All right. And the rate at which they are really desperately looking for these customers tells it all. All right. And they're not able to generate serious growth rates here from whatever business model they're engaged in. Whatever business model they're engaged in. So if you want, in this case, ladies and gentlemen, you must be able to have, in this case here, retentions from your salaries, from whatever profits you have, and then you invest those retentions nicely to be able to get some return. And the moment you take the two, then automatically, ladies and gentlemen, in this case here, you are where? You are in business. You are in business. So I would want us to look at an example here before I ask you guys to give me any artist that you know who plays, who sings for us these R&B songs. We want to see whether there is any accountant who could be knowing any artist, any great singer of R&B. Let's see here. So we are given here a situation where EPS is 10. Dividends paid 6. Dividends paid 6. Return on equity is 10%. 10%. So we are required to calculate, G, calculate G, which is the growth rate. So once I start, here, I'm not given like many dividends. I'm not given many dividends that I can now use that formula of 1 plus G equals blah, 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 blah. No. They have given me very scanty information and they want me to calculate G. So I must dance a little bit. So in my solution then, my G will be equal to R and B like that. So this B is the retention ratio. How do I get my retention ratio? I can see we earned tenable. And I paid how much? Yes, somebody 6. So is there somebody who is able to see the savings? Retention is the same as savings. What we retain is what we save. So the company was earning 10 bob per share. They paid out 6. So in this case here, the savings is what here somebody, the savings is what here somebody, the savings is 4. So in this case here, we have savings over the total earnings as a retention ratio. Savings over the total earnings like that. So the savings here we have 4. EPS we have 10. So then this will give us what we call 0.4 or 40%. Serious organization, very aggressive organization. Somebody may tell you that another method here, somebody may tell you method 2, that when first of all calculate dividend payout ratio. Dividend payout ratio. How do we get dividend payout ratio? We normally take DPS over EPS. So the DPS here is 6 over EPS of what here? 10. So 6 over 10, which will end up giving me 0. What here, which will end up giving me 0.6 like that, So calculate the dividend payout ratio. This will be 0.6. Great. So if the dividend payout ratio is 60%, if what I'm able to pay out there is 60%, that means that what I'm able to retain is 40%. So retention ratio, then this will be 1 minus dividend payout ratio. So 1 minus 0.6, which gives me 0.4. Which is 40 what here? 40%. So the retention ratio will be 1 minus dividend payout ratio, which will end up giving me 0.4, So up to here, are we somehow together really? Up to here? Correct. And then from there, then we have in this case here growth rate equals R&B. So this is the return. The return has been given to us, it is 10%. Multiplied in this case here by our B. B, remember, is the retention ratio, which happens to be 0.4. then this one here will end up giving me what answer. You can say 0.1 times 0.4, whatever you get, times 100. Times 100. Or just 10 times 0.4, which would be 4%. 4%. So is there some good reason you see 4% here as the growth rate? Anybody is able to see that? 4%. Yeah. So, and then of course, if for example, now they went ahead, if for example, they went ahead, in this case here, extended question, if they went ahead and asked me the value of a share, I would have very comfortably given them the value of a share. PO means value of a share, the current market price per share. So if they ask me to give them value of a share using Gachagwa's formula, I know this will be DO into 1 plus G, all over cost of equity minus G, all over cost of equity minus G, all over cost of equity minus G. So ladies and gentlemen, if I do it this way, I will end up getting what here? My PO will be equal. The current dividend is here. It is this 6 into 1 plus now the G, which is 0.04. All over cost of equity, what we are calling return on equity, what the equity holders are calling a return, to the company it's a cost. So the cost of equity here, the cost of equity is 0.1 minus this growth, which is 0.04. So I would have very easily gotten the value of a share. And this value of a share, as we shall be seeing later on, will really be instrumental in terms of valuing our organizations. In terms of valuing our organizations. Here. So can somebody in this case here go ahead and give me the numerator? Can somebody give me the numerator? Go ahead and give me the numerator. So our PO will be 6 times 1.04. What is 6 times 1.04? Formula ya shift. Hili gani hiyo? Formula shift. Kumbuka hapa kuna kushift, hapa unasema tu 6 times 1.04, right? So unapata, I repeat, okay, all right. So in this case here, first of all, give me this 6 times 1.04, 6.24. So 6.24 all over this minus 0.04, which gives me 0.06. 0.06. So what are we able to get here? 6.24 divided by 0.06. So that gives me 10.104. That gives me value of a share of 104. So I don't know whether the shift thing maybe is here. I don't know very well. The shift thing, is it in this? Because it's where we encounter shift. Where we encounter the shift X root. That's where we encounter the shift X root. So for example, if you're given here 10th root of say 100. Look at this is 10th root, not 10 times square root of 100, 10th root. So then what I will do, I know there is a button there written like this, raised to, right? On top of it, there is an X root. And this X root is yellow in color, So meaning that the first thing that I will do, I will press this 10, right 10 there, and then I say shift, press this. So if I say shift, press this, then I'll be able to see something coming up there called X root. And then I say 100. So can somebody give me this figure here? 10. So this gives me what here? Yeah, somebody is assisting me there, which is very good. So the final answer is 1.5849. 1.5849. 1.5849. Which we say, if you don't like this method, this will be the same as 100 raised to 100 raised to, this will be raised to what here, somebody? Raised to 1 over 10. If you don't like this extra thing, you can come and say 100, and then you press this raised directly, raised to 1 over 10. But remember, this 1 over 10, no, you must put in brackets. If you don't put in brackets, then you're done. You're done. You're done. You're done. You're done. So if I take 100 raised to 1 over 10, these in brackets, will I still end up getting the same answer? Will I still end up getting the same answer? Will I still end up getting the same answer? Will I still end up getting the same answer? All right. So I believe this ninja who asked us to repeat this has now been able to get it. If that is what they were asking. You know, some of the questions you ask are nice, but they're not complete. Like, you know, the student who is telling me to repeat this. I don't know whether they want me to start from how we got the retention ratio for the savings, from savings here, from savings. You see, we have here EPS is 10. DPS is what here is 6. So the company has been able to earn 10 bob. And then they are paying how much here, somebody? They are paying 6 bob, isn't it? Then somebody should be able to see how much, the company is saving. How much are they retaining? How much are they retaining? So in this case here, the share has earned 10 from their business. They've been able to earn 10. Now they are paying 6. So in this case here, the savings will be 10 minus 6, which will be what here? Which will be 4. So in terms of percentage, so in this case, in terms of the ratio now, so the retained ratio, or the retaining ratio, So retaining ratio, so this will be 4 out of the total amount earned. So 4 out of 10, which will be 40%. So how much have you saved vis-a-vis what you earned? 4 over 10. So this will be 0.4, or would you have come and said, you can as well use method 2. So under method 2, we have what we call the dividend payout ratio. Dividend payout ratio. How do we get dividend paid out ratio? So dividend payout ratio, we normally take DPS over EPS. So our DPS, what is our DPS here? It is 6 over EPS, which is what here? Which is 10. So this gives you 0.what here? 0.6 like that. So this is what we've been able to pay, which is the same as 60%. So we are paying 60%. So we are paying 60%, and how much are we retaining? Therefore, retention ratio will be equal to 1 minus the dividend payout ratio. So this dividend payout ratio, which will be 1 minus 0.6, which gives us 0.4, same as 40%. All right. DPS is dividend per share. Dividend per share. Yeah. So you see, we have DPS is dividend per share, earnings per share. Then we have like MPS. MPS is market price per share. Winnie, were you exempted from doing financial management of intermediate level? Were you exempted from doing financial management of intermediate level? Is there anybody who was exempted from doing financial management of intermediate level? Those are the people I love. Those are the people I like. Great. So you won't be disadvantaged at all. But also that tells me that you guys don't read the newspapers at all. We use these terms every time. Like business daily. You see DPS, MPS. All right. So we are overcoming. So now I hope now everything is clear up to there. And then of course, after you've gotten the retention ratio, you can now come and get the growth rate. So growth rate is R&B. R&B. All right. So the return on equity, this has been given 10%. The B you have got under the retention ratio is 0.4. This one here will be 4%. 4%. Mm-hmm. 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 Very good. So G is RB regular. After you've gotten out G, at times they'll come and ask you to ascertain, they'll come and ask you to ascertain the PO, get value per share, which will be DO into 1 plus G over cost of equity minus G. Right? So now I believe up to here, you guys now are a little bit comfortable and you'll be able to do what here. You'll be able to get to view this video again and again. All right, great. So what of this situation when you are given, in this case here, like for example, net income, yes, over company, like profit after tax, and then you have in this case here equity. You have equity. Yeah. So if you're given here, for example, net income and equity. So that one, then automatically, as we shall be seeing on Modigliani and Miller, that when you have in this case here this profit after tax, right? So you've been able to earn, You've been able to earn here profit after tax, and then you have in this case here equity. We have in this case here equity. So you see, equity is what these guys have invested. The company owners have invested in equity. They've bought shares of a company. They've given a company capital. This company goes and does business, and they're able to generate net income. They're able to get profit after tax. So assuming that this profit after tax will go to all these guys only, there are no preference dividends, then when you take PAT over equity, we're going to see automatically that this is the same as what here? Cost of what here? Cost of equity. Yeah. So because if the entire amount is paid to them as dividends, but we shall come back to this. It's not a method of getting G. For G, I've shown you the two methods. All right. So then that now takes us to our past papers. Are they ready for a past paper question? And because I would want to use this very video for my financial management, I want to start another video.